Morning. So today we're going to discuss about the once more about the inventory, the merchandise inventory, and we're going to introduce the inventory costing methods or assumptions. So today we're going to see how the inventory is measured, the value is estimated, and also how the cost of goods sold is determined. Because so far we just assumed that we knew what the cost was, but how do we know what is the value of the inventory sold? I mean, that's pretty easy if you have just one transaction. Okay, so you purchase inventory and you sell it. Okay, that's pretty simple. What if you buy the inventory at different times, at a different end, at different prices, which is the most important part, and then you sell it? And if you just sell part, maybe you just sell part of the inventory. How can you tell what the value of the inventory is? So today we're going to take on this problem. We're going to learn exactly how to measure the value of the inventory. Moreover, there are problems with the issues with the value of the inventory at the end of the year, meaning that let me just go to my there someone has their microphone on. So moreover, we also have the following problem. Let's assume that you have the value of the inventory at the end of the year, the periodic, the perpetual method of merit. Okay, so let's assume that you have the cost of the inventory. And then you compare this with the market value, okay? And the market value is lower, so the market value is less than the cost says. What do we do? Should we just report the cost, even if the market value is less than the cost of inventory? Should we lower the value of inventory in order to reflect the current market value? Okay, so there's another problem we need to solve, which is related to the measurement of the inventory. What if the market value is greater than the cost? Should we update the value of the inventory? Okay, so those are other issues we need to solve. We learned that we need to be conservative, of course, in financial reporting. So we're going to apply the lower value. Okay, so if the market value is less than the cost, we apply the market value. If the cost value is less than the market value, we keep reporting the inventory at cost. But that's something that we're going to see later. For now, let's introduce this problem of the inventory costing method with an example. Okay, so let's assume that we have the following situation in our inventory. First of all, we have a beginning inventory. Remember beginning, ending, okay, it means that beginning is the value at the beginning of the reporting period. It could be January the 1st, for instance. But this time, instead of just thinking in terms of total value, let's think in terms of units and per unit cost. Okay, so we might have 100 units, let's say at 50. Okay, let me be clear, 50 euro. Okay, so it's not just 50 in general. Just a second, because well, to get rid of this, that's a second. Okay. So by 50, I mean 50 euros. Okay, so clearly the beginning inventory will be worth, in this case, 5,000, right? Okay, then you have different purchases. So purchase one. Okay, let's say we buy another 200 units, and this time at 55. Okay, and then we buy. Also, just a second. I need to calculate this. So that's 11,000. And purchase number two, another date. Okay, you buy another, let's say, 50 units at 60. Okay, let's assume the prices are increasing pretty fast, actually. So that's 3,000. Okay. Okay, so if you look at the inventory, you're going to find the following situation now. Okay, so you have 100 units at 50, 250 at 55, and 50 at 60. Okay, both at different times at different prices. So the assumption here is inflation. Okay, so prices are increasing, and also maybe it's a little bit exaggerated, but not that much, because you know that sometimes, especially in the last 2 years, prices have increased pretty fast in some areas, for some commodities. Now, let's assume that we have a sale now. Now we sell, okay, we sell 100 units. No, let's say 150 units. Okay, this is the number of units we sell. Problem is, what is the cost of goods sold? What are the units we're selling? Okay, are they measured at 50, 55, 60? What is the cost of goods sold? We know what the selling price is, of course. Okay, let's assume we can sell them at 100. Okay, that will be the selling price, but that's the sales revenue part of the problem, and we don't have to estimate anything. The problem is, how do we determine the cost of goods sold? Okay, I'm thinking about the perpetual system right now. So clearly, there are several options here. You could, for instance, identify the specific items you're selling. So I know I'm selling, for instance, 50. I'm selling the 150 units. They come from the first purchase I made. So I know that they are worth 55. Okay, if somehow you can tell that, if you can tell the precise units you're selling, if you can identify them, you can use the specific cost of those units. This is possible, of course, although keeping track of that may be expensive, because it could be applicable to some industries. For instance, if you're selling cars, okay, clearly you know exactly what car you're selling, so because they have an ID, okay, so you know exactly what car you're selling, so you know exactly what the cost is. Okay, if you're selling, I don't know, in tuna fish cans, clearly you don't know exactly which is which. Okay, so you're not really keeping track of each single can and with its purchase price. So in that case, it's easier to apply some conventions or some assumptions. Okay, so for instance, we could assume that the oldest units are sold first, right? That's reasonable enough. Or we could assume that the newest units are sold first. Okay, that's another assumption. We don't actually know, okay, and we don't actually sell the oldest units first or the newest units first. It's an assumption that's necessary for measuring the cost of sales. Or we could calculate the average cost of the units sold. So we have different methods, and let's say the most common and the most commonly accepted methods are the following. So you can use a method called, let me use a blank page. We can use a method called cost called FIFO. First in, first out. Okay, that's one of the inventory costing methods. So FIFO means first in, first out, which is, I mean, reasonable, right? You think that, well, the oldest units are being sold first, and therefore we can determine the value of the units sold applying this costing method. Or you could apply LIFO, which means last in, first out. So the last units bought are the first to be sold. There may be other systems out there. For instance, the units with the highest value are sold first, so HIFO. Okay, but those are not allowed by accounting standards. You can also calculate an average. Okay, so you can use the weighted average cost. Okay, so let's say those are three methods. Okay, the weighted average cost calculates the average, but it is weighted by the quantities, as we'll see. I repeat, there may be others, but those are typically the ones allowed by accounting standards. Not even all of them are allowed by all the accounting standards, as we'll learn. But those are by far the most common. So we need those assumptions, those costing methods to simplify the accounting process, because without them, we should identify the specific units we are selling. Okay, and as I said, in some cases, that's actually how it's done. In other cases, it may be complex and expensive to do. Okay, so companies prefer to apply costing methods, which are assumptions. So we don't change the fact that we need to measure the cost of sales at cost. Okay, so it's just an assumption about the actual value of the items sold. So if we go back to the previous slide, and we need to determine the cost of goods sold for those 150 units. Now, you see, we have different results depending on whether we use one or the other assumptions. For instance, let's start with FIFO, first in, first out. With FIFO, the oldest units are sold first. Okay, so the oldest units clearly are the related to these two different values, the beginning inventory and the first purchase. Okay. Why do I need the first purchase? Because I'm selling 150 units and I only have 100 units in the beginning inventory. So I cannot possibly sell 150 units at 50 because I don't have them. Okay, so if I apply FIFO, okay, so let's say the first solution would be, let's apply FIFO. Okay, first in, first out. That would be 100 units at 50 and 50 units. Okay, at 55. Okay, that would be the cost of sales. Okay, so I'm imagining, I'm assuming, it's not necessarily real, but I'm assuming that I'm selling the oldest units first, which are the beginning inventory, and since those are not enough, I'm selling 50 units from the first purchase. Okay, please note, you cannot sell 150 units at 50 because you don't have 150 units measured at 50 in your inventory. Okay, you only have 100, so you need to use the second oldest purchase in order to determine the cost of sales in this case. So this way you can tell what the cost of goods of credit inventory, but then you know how it's been determined. You know exactly how the cost of sales was calculated. You also know what's left in the inventory. Clearly, if you apply FIFO, your inventory will still have 150 units at 55 and 50 units at 60. Okay, they will still be there and available for the following sale will be based on these units. So if you have dozens of different values in your inventory, clearly it's useful using some sort of assumption that would make our life easier, I suggest in this case. In case of LIFO, the cost of goods sold will be based on the newest units, right? So that would be 50 units at 60 and 100 units at 55. Okay, so I'm working away from the bottom to the top. Okay, so up to the top. So I start from the latest purchases. So the latest purchases is this one. Okay, the second purchase, and okay, that's the latest purchases and latest purchase, and therefore I'm imagining I'm selling those first 50 units at 60. And the other 100 units are taken from the second newest purchase, which is 255. So they must be 100 at 55 euro. Now we'll proceed with the example just to give you an idea what we mean, okay, by LIFO and FIFO. Clearly, if you use LIFO, the oldest units are still in your inventory. Right, that's the idea, because you sell the newest units first and the oldest, well, essentially you never sell them unless you sell the entire inventory. Okay, you're going to have to, if you purchase and sell, then the newest purchases are going to be sold. Remember, this is not the physical flow of the inventory. Okay, it's just an assumption. We don't know what happens physically to the inventory. In reality, FIFO is probably closer to what happens in reality, okay, to what happens to the physical flow of the inventory, and LIFO is not probably very realistic, okay. Although LIFO has interesting properties, it has interesting effects when prices are increasing. Okay, as you can make, as we'll explain in a moment, if you change the assumption, okay. Oh, sorry, if you apply one of the other assumptions and prices are increasing, then you have different effects, different consequences on your cost of goods sold and therefore on your net income. Okay, so the choice between the two methods is not indifferent. It generates different effects on the financial statement. This is applicable, of course, when prices are changing. If the prices remains the same, if the prices remain the same, then you don't have any difference. But if prices are changing, then there are differences. The weighted average cost is somewhere in between the two methods. Okay, it gets you, a middle ground result between LIFO and FIFO. The weighted average would be the average price weighted by the quantities. Okay, so if you look at this, you have three different prices, 50, 55, and 60. You don't simply calculate the average of those three numbers, okay? You calculate the average weighted by the quantities. Let me explain the idea. In our example, we say we have 100 units at 50, then we have 200 units at 55, and we have 50 units at 60. That will be the total value of the inventory, right? The total inventory would be 100 units at 50, 200 at 55, and 50 at units at 60 euro. What is the average cost of the inventory? You divide this by the number of units, the total units, okay, which is 100 plus 200 plus 50. And you get the weighted average cost of your inventory. Okay, so it's an average cost, but it is going to be weighted by the quantities. Okay. So essentially, it's the total value of the inventory divided by the units in inventory. Okay, you get an average cost per unit, which is affected by the different quantities. That is, those 200 units at 55 will weigh more than the others, okay, because of this weighted average. So you get an average cost. You're going to apply this average cost when you sell. Okay, so the assumption is I'm selling this at this average cost. So this is equal to 19,000, which is the value of the inventory in euros, okay, divided by the quantities, which is 350 units. So that's 54.29. Okay, that's the average cost. Okay, so if you sell 150 units, the cost of goods sold would be calculated as 150 multiplied by 54.29. The average cost changes each time you buy new inventory, right? Because you change the value, the inventory, the quantity. So for each new purchase, you have to change the weighted average cost. And this example, now we're going to review this and also to study the effects of those inventory costing methods on the financial statement. But this example, it's applicable to the perpetual inventory. It is for each single sale, you determine the value of the sale, of the cost of goods sold, and you determine the value of the inventory sold. We also apply this to the periodic system. In that case, it will require us a different form of application because we are going to measure the quantities. We count the inventory at the end of the period, and then we need to apply the LIFO or FIFO logic to determine what's left in the inventory. Okay, so if you use LIFO, the inventory will be the oldest prices, measured at the oldest prices. If you use FIFO, the inventory will be measured at the newest prices. Okay, so this is essentially the problem we're going to face. So with this introduction, I hope I explained the problem. Okay, so the problem we face. The problem is, how do we know what is the value of the inventory that we are selling? Because sometimes just identifying the specific cost of the inventory can be very expensive, and maybe it's not even worth it. I mean, it's not even worth it spending money on setting up a system that measures the exact price of the inventory sold. In some cases, it can be impossible. For instance, there is an industry that uses LIFO, is the oil industry. Okay, so when you sell oil, how can you tell if what you're selling is the oldest units, the newest units, the oldest barrels, or the newest barrels? It's all in the same, physically, it's all mixed, right, in the same container, the same tank, essentially. So when you sell it, you need to apply some costing method. Okay, and the oil industry historically has always favored LIFO over the other methods. LIFO is not really allowed anymore by the international accounting standards because they believe it's not realistic. Okay. However, LIFO is very popular in Italy for tax reasons, and also it's very common under the US standards because they allow companies to use LIFO. So there are differences around the world on how we use this method. But keep in mind that small Italian companies, those that do not use the international accounting standards, they use the national standards. They use LIFO a lot, so it's very common. larger companies, international companies that apply international standards, they must use either FIFO or weighted average cost. US companies can use one of those three methods, and there are many that use LIFO. All right, so let me now explain a bit better the effects of the different costing methods on the financial statements. So we're now introducing a topic which is covered by Chapter 6 of your textbook. Just a second, let me make sure that everything is working. All right. All right, so I'm going to skip some of these parts. For instance, identify the accounting principles, controls. Okay, this is not really very relevant to us for the moment, but accounting for merchandise inventory cost under perpetual inventory system, what we have just introduced. So we're going to study that, the effects on the financial statements with different inventory methods, and then what to do at the end of the year. Okay, once you measure the inventory, what do? We need to compare the value of the inventory with the market value. And we need to apply the lower of cost or market rule. That is, we apply the cost value or the market value, whichever is lower. Okay, so this is the rule. And we also need to apply the merchandise inventory cost under the periodic inventory system, okay, which is going to require a different approach to what we are seeing here. You get different results. Okay, so when you use the perpetual system or the periodic system, if you apply LIFO, or for instance, or average cost, you don't get the same result. Okay, you get different results. Let's proceed with the order. I'm going to skip this part. Okay, so let me skip this because it's not really related to the inventory. It's related to the financial statements in general. Okay, so I would like just to show you this part. To mention this, the control over the inventory. It's something we mentioned already. You want to prevent errors, to prevent fraud. Okay, so there are some controls, rules, procedures to follow that will minimize those risks. For instance, making sure that in order to purchase inventory, you need proper authorization. So not anyone in the firm can buy inventory, because clearly you need to specify procedures in order to control the inventory. You need to make sure that anything is going to be documented. Any damages to be recorded. The physical count should be performed at least once a year, at least, even if you use the perpetual system. Okay, you should also make sure that the balances you see in your accounts are consistent with the physical count of the inventory, and of course updating the inventory when it is sold. So you need to update the accounts when it is sold. There are other controls that are not mentioned here. For instance, as I say, that those in charge of accounting for the inventory should not have access to the physical inventory. Okay, so otherwise they could, easily hide their traces and steal some of the inventory. All right, so let's get rid of this. Okay, so let's start now with the merchandise cost, inventory cost methods. Now we are talking about the perpetual system. So we have now explained that we need to think in terms of units and per unit value. Okay, because so far we simply said, well, the inventory is worth 20,000. Okay, which is the total value in euro. But behind this value, there are the units and the costs per unit. Okay, so the ending merchandise inventory, the inventory at the end of the year, is equal to the number of units on hand that is available, okay, multiplied by the per unit cost. And of course, the cost of goods sold will be determined by the number of units sold multiplied by their cost per unit. So we need to think in terms of units, physical units of the inventory. It could be, of course, units, could be, in case of some goods, it could be measured by the barrels, it could be liters, it could be tons, okay, depending on what we're selling. Okay, so it's a measurement and estimation of something which is with physical quantity. Okay, so we need both. We need both the physical quantity and the cost per unit. So when we say we have the physical count of the inventory, we physically count the units, and then we need to determine the value of those units. Okay, so it's a measurement process. We need to assign dollar amounts or euro amounts to the units, and because we report the total value of the inventory in our accounts, but behind that value there is a physical count with the units and the cost per unit. So here we have an assumption which is similar to what I have already shown you on the whiteboard. Okay, so we have a series. It's pretty small print, so I hope you can read this. But you have a series of purchases. This is August, the 1st, 15th, 26th, and 31st, and so on. Okay, so different dates, and you have the quantity purchased, the quantity sold, and the cost per unit. Okay, so something similar to what we have seen so far. Now, in this case, clearly, if the assumption is the cost per unit remains the same, 350. So in this case, no matter what method you choose, the result will be the same. The point is you should always know what the quantity on hand at each date. Okay, so this is perpetual inventory. So if at any time you know exactly how many units are left, okay, with the perpetual system. And based on this schedule that you see here, you can determine the cost of sales and the ending inventory. For instance, if at the end of the period you have 4 units, and you know that the cost per unit is 350, you know what the value of the ending inventory is. Okay, so it's going to be 4 units multiplied by 350. If you sold 14 units, and the cost per unit is 350, then of course the cost of goods sold will be 4,900. The problem is the cost per unit is not always constant. Okay, it's not always steady. It's not always the same. The cost per unit can change, and that's why we need the inventory assumptions. So if we have in this case an assumption which is similar to the example I made, that is the cost per unit is now increasing, 350, 360, 380, okay, inflation. And when the cost per unit increases, of course, this part here, the quantities remain the same, okay? It's not like we change the quantities, but we need to determine the value of the ending inventory, 4 units, and the value of those sales, okay, 4 units on August the 15th and 10 units on August the 31st, right? So we need to apply some methods, some of those inventory costing methods to this program. So we had, as I said, the different costing methods. If you identify the specific cost, it's called specific identification of your cost. So you know exactly, okay, what you're selling. You identify the specific units you're selling, so you know exactly their cost. So you don't have to worry about the assumptions. Otherwise, we have the FIFO method, LIFO, and the weighted average method. Okay, those are the costing method allowed by generally accepted accounting principles. Just a note, remember what I said, that the LIFO method is not allowed by international standards, which are called IFRS, International Financial Reporting Standards. Okay. What are they? Those are standards used in the European Union and elsewhere, okay, not just in the European Union. Let's say in about 100 countries around the world, okay. Typically by large companies. Okay. However, LIFO is allowed by the national standards. So, for instance, in Italy, small companies can use LIFO. It is also allowed by the US GAAP. Okay, so US standards. So even large American companies can use LIFO. Okay, so there are different ideas out there on whether LIFO would be a good or a bad idea. The reason why the international standards don't like LIFO is because it's not realistic. So it's not realistic that you actually sell the oldest units first. However, it has great benefits in case of inflation. So it's very common for this reason, because it produces a more realistic figure for your net income in case of inflation, as we'll see in a moment. Now, of course, I made a mistake. I wanted to write this note, not here, but in the LIFO, sorry. I was talking about LIFO, and I wrote this, the LIFO is not allowed, not the FIFO, okay? Sorry about that. This straight line here, this is the bug. I cannot get rid of this. Okay, so LIFO is not allowed by IFRS. Okay, but as I said, it's quite common in Italy, so we need also to learn how it works. So let's start with the specific identification, which is not a method at all. I mean, it's not an assumption at all. Okay, so you simply know exactly the units you are selling. You can identify them precisely, so you know exactly how much they cost. So this is clearly used in some cases, okay, automobiles, jewels, real estate, selling houses, you know exactly, okay, what they're selling. You don't need to, to use some inventory assumption methods. So you know exactly the cost of the particular units you are selling. Okay, so this is a case where we're not assuming anything. We know what the cost is. So if you know what is the cost of the single unit you're selling, you apply that cost to the cost of sales. And what if you don't know, or you could know, but it would be too expensive to collect this information? If you don't know the precise units you are selling. Now, just a note, we're talking about merchandise now, but you can apply this to other items. For instance, financial investments. So banks, insurance companies apply these methods to their financial investments. If you buy shares of the same company at different times, at different prices, then you sell them, what is the profit? Well, you should identify the precise instruments you're selling, or you can apply some inventory costing method, like what FIFO and so on. So now in this table here shows the application of a specific identification method. In this case, the instruction is that we know that 1 unit sold at the cost of 350 and 3 at the cost of 360. So in this case, you don't have to assume anything. And you also know what the cost of sales is for the the last sale of 10 units on August the 31st. So if you happen to know this, you don't have to assume anything. You simply calculate the cost of goods sold on the basis of this information. Okay, so clearly the first sale will have a cost of 350 times 1 plus 360 times 3. Okay, you sell 4 units. Okay, and you know exactly how much they cost. The second sale, 10 units, would be 1 unit at 350 and 9 at 380. Now, in this schedule here, which is difficult to read, but we use Excel to explain how this works. So it would be easier for everybody to read. This schedule shows the purchases, the cost of goods sold, and the ending inventory, or inventory on hand. That changes every day, okay, as we buy and sell the inventory. So we have the purchases, 4 units and 12 units, 4 at 360 and 12 at 380. But we also have a beginning inventory of 2 units at 350. Okay, so this is the situation we have here. And we have a sale on August the 15th and another on August the 31st. Now, since we assume we know this information here, we have this, we can identify the specific cost of the inventory sold. Okay, so therefore, we can also determine what's left in the inventory, okay, which is also important. The inventory on hand is calculated on the basis of what we have sold. And in this case, you can observe how we don't assume anything. So, for instance, the cost of sales, when you sell on August the 15th, you sell 4 units. If you happen to know the specific cost, you can also determine the total cost of sales. Now, the journal entry and also the ledger will show the total value. Okay, so if the cost of goods sold is 1,430, the entry would be debit cost of goods sold, freight inventory 1,430. Okay, you don't see the details, but behind that there is a detailed schedule like this one, because the company needs to keep track of the inventory in real time, and they have this detailed schedule of the inventory, so they know exactly how to journalize, okay, the engine, because they know the amounts, the values, and the cost per unit. What if instead we apply FIFO, first in, first out? Now, as I said before, this seems rather reasonable because FIFO assumes that the oldest inventory is sold first, which is, I mean, reasonable, right? Especially if you think about the grocery store. Okay, so food, clearly the oldest food is going to be sold first. That's why the newest stuff is always in the back of the shelves, right? So this is the also let's say something realistic in some cases. So the assumption is that the cost of goods sold is based on the oldest purchases, and as a consequence, the ending inventory will be based on the newest value. Right, so the newest purchases will be still there at the end of the year. The oldest purchases will be sold by the end of the year. Okay, so this is an important note because it means that the FIFO method, the FIFO method essentially affects the ending inventory, and it makes it here it says close to the current replacement cost. What is the replacement cost? The price you will pay to repurchase the inventory. Okay, if prices are increasing and you use FIFO, the value of the inventory will be close to the current prices because it will be the newest values. The cost of goods sold, on the other hand, will be based on the oldest values. Okay, so this is the effect of FIFO. Now, let's see an example, then we'll have our break. The assumption now is FIFO, so we don't know what we're selling exactly. Okay, so we apply this assumption. So remember the beginning inventory that's here. Okay, was 2 units at 350. and then we purchase 4 units at 360. Okay, and then we have a sale, and we sell 4 units. Okay, so right now you have 6 units in your inventory, 2 at 350 and 4 at 360, and you sell 4 units. Now, if you use FIFO, we are going to sell the oldest units. And the oldest units are those that measure at 350, so 2 units at 350. And we're also going to sell 2 units at 360, which is the second purchase. Okay, so you see here, we sell 2 units at 350 and another 2 units at 360. So we get a total cost of goods sold. Sometimes some students, they believe that the FIFO method means that we use the oldest price. So they sell 4 units at 350. It is not possible because you don't have 4 units at 350. You only have 2 units at 350. Okay, so we need to be consistent with the units on hand. So you can't possibly sell 4 units at 350 because you don't have them. Okay, you only have 2 units. So once the oldest units are sold, then you need to sell the second oldest units, and so on. Okay, so keep in mind that we need to identify the cost of the units sold. Okay, it's not like we simply apply the oldest cost to all the units. We cannot do that. So if you sell 4 units, you had 6 units. You sell 4, you're left with 2 units. Right, and those 2 units will be measured at the newest price, which is in this case 360. Then you have another purchase, 12 units at 380. Okay, so prices are increasing. So now the number of units on hand will be 14. Okay, 2 at 360 and 12 at 380. And now we sell 10 units. Once again, applying the FIFO logic, we sell the oldest units first. So we sell 2 units at 360 and 8 units at 380. Okay. How many units are left? 4 units. And what units are they? Those are the newest units, and they are measured at 380. Okay, this is why we say that the FIFO method will generate an ending inventory which is close to the current prices because it's based on the most recent purchases. So the ending inventory will be based on the most recent purchases. On the other hand, the cost of goods sold will be based on the oldest purchases. Okay, so the problem is you're somehow estimating correctly, okay, or as closely as possible the ending inventory. You're somehow understating the cost of goods sold because it's based on all the values. It's difficult to get both right. I mean, to get the cost of goods sold and the ending inventory close to current prices, because when prices are increasing, this is not really easy to do. Now, we'll see after the break what happens with LIFO, the same example of LIFO, and then the average cost, and then we need to practice, because again, when we'll apply this to the periodic system, the logic will be different, because in the periodic system, you don't generalize each single sale, but you have an ending inventory. And the problem is, okay, what is the value of this ending inventory? So you count the inventory, you realize you have 4 units, then what? Okay, then you need to determine the value of those 4 units. Okay, and we'll explain how it works after the break. So we'll resume in 10 minutes. Okay, so I realized that if you stick to the back, you can't possibly read the slides, so because it's such a small print, so I'm going to zoom in on this table that I was illustrating earlier. Okay, so at the same table, uh, just a larger print. So remember, this is still the FIFO method. Okay, so still talking about FIFO. Okay, so we have here the sales. Okay, so 4 units. Okay, and using FIFO, we assume that you are going to sell the oldest units, so 2 units at 350, and also the most recent, the second, let's say, oldest units, which are 2 units at 360. Okay, and then we have another purchase of 12 units, and then we sell 10 units. Okay, which are once again the oldest, which is 2 units at 360 and 8 units at 380. At the end, we have 4 units eventually, and those 4 units will be based on the newest value. Okay, because under FIFO we apply this logic, so all the ending inventory will be based on the newest units. What about LIFO instead? And then we see the journal entries, but the journal entries do not change when you switch from LIFO to FIFO to average cost. The journal entries are identical. The difference is the amounts we report in cost of goods sold. So this is LIFO, and in LIFO, remember the same assumption that is 2 units at 350, and then we buy another 4 units here at 360, and we sell 4 units. Now the latest purchase was 4 units at 360, so we assume we are selling exactly that. So we sell 4 units at 360, which are the newest units we have. So the oldest units, the 2 units at 350, remain on hand. They remain in inventory essentially. So the cost of goods sold for this first sale will be 1,440, and then we purchase 12 units at 380, and we sell 10 units. What are we selling? We are selling 10 units at 380 because those are the newest units on hand. Now, what's left? What is the ending inventory? Well, we still have 4 units, of course, okay, because the number of units does not change, but the units available are now 2 units at 350, which is the original beginning inventory, and 2 units at 380, because we sold the 4 units at 360 that we bought. Okay, so in the perpetual system, you need to be careful. You need to follow the physical flow of the inventory for each single sale. And since we sold 4 units at 360, we don't have anything left, okay, of that purchase. The value of the inventory should be based on the oldest units, 2 units that are still there at 350, and we still have 2 units at 380 in our inventory. And then we'll have a look at the total cost of goods sold and total value of the inventory, and we'll compare the results. The average cost requires you to calculate the average cost after each purchase, because it's going to change essentially for each purchase. So, for instance, initially the cost per unit is 350. You see that here, which is the beginning value. And then you purchase 4 units at 360. That changes the cost per unit to 356, according to the formula we saw before. Okay, so the total value of the inventory divided by the number of units available. If you sell 4 units, you're going to apply this value. Okay, the average cost of the inventory. When you buy 12 units, this is going to change the cost of the inventory because now you have 14 units and the average cost of 1 unit is 376. It changes because we need to recalculate the average cost every time. Okay, so when you sell 10 units, the cost of goods sold will be based on the average cost, the new average cost. So you can observe we have 2 different values for the average cost, the different average costs, because the average cost per unit changes as we purchase new units. Okay, so in the perpetual system, you need to recalculate the average cost after each purchase, which is not really a simplification, right? But you have to do this for each purchase. Eventually, the 4 units left, the inventory will be based on this average cost, so their value will be 376. Okay, so that's the value of the ending inventory. So if you compare the 3 methods, okay, so let's start with, let's go back to FIFO. Let's have a look at the cost of goods sold and ending inventory. Okay, under FIFO, the cost of goods sold was 5,180 total, okay, for the period, and the ending inventory was 1,520. Under LIFO, the cost of goods sold was 5,240, so it was greater, but the value of the inventory was smaller. Okay, why? Because since prices are increasing, that's the assumption, okay, otherwise it doesn't work. If prices are increasing, LIFO will generate a lower value of the inventory, lower than FIFO, but a greater value of the cost of goods sold. Okay, so the inventory is going to be somehow understated, but the cost of, so not very close to the current replacement value. But the cost of goods sold will be based more on the most current prices. Okay. In periods of inflation, LIFO is popular because it generates a performance which is more, let's say, accurate than FIFO, because you compare the sales revenue, which is at current prices, with current costs. Okay, with the cost of goods sold, which is measured at the most recent costs. The downside is that the inventory can be understated, and in some cases can be severely understated. Think about cases where you keep buying and selling. The risk is you never sell the beginning inventory, that it remains there potentially for years. Okay, so the downside of LIFO is that the value of the inventory can be really understated. But we'll see that there is a mandatory disclosure of the difference between the current value on the market and the cost reported in the balance sheet in case of LIFO. In fact, in some cases, this difference will be very large. We'll see some examples. The average cost method achieves some middle ground solution. Okay, so it's in between the 2 methods, in between LIFO and FIFO. So the consequences of these methods are what's really important for us to understand. The journal entries, now we're going to have a look at the entries, are not really different. I mean, the journal entries are Just a second, I need to juggle between my screens, so just a second. Okay, and I'll be back in a moment. Okay, here we go. Now, I was talking about the journal entries, and they are not really special. I mean, they are your usual journal entries as far as we know that we have in merchandising. With the perpetual inventory, okay. The difference is the amounts. Okay, so amounts unique to FIFO are shown in blue, which is the cost of goods sold, first sale and second sale. Okay, so this is the effect of this method on the journal. So the entries are simply always the same. The point is, how do we determine the value of the cost of goods sold, the amount of the inventory sold? Well, we apply FIFO, and that's the result. In case of LIFO, same entries, but the values are different. Okay, so once again, the cost of goods sold will be different. In the journal, there's no way to tell whether you're using LIFO or FIFO or whatever. There's no special entries, okay, just for LIFO or for FIFO. The entries are always the same. Debit inventory, credit accounts payable when you buy, debit account receivable, debit credit sales revenue, debit cost of goods sold, that's what matters, and create the merchandise inventory. Because we use the perpetual system and we account for each single sale. So it's not really a matter of entries. By the way, how do we determine using the weighted average method, how do we determine the average cost that we saw in the table? Well, the first average cost was 356. It's determined as the total value of the inventory on hand divided by the total units on hand, as we saw in this morning the example. Okay, so you have the total value divided by 6 units, and you get 356. So it's not the average of the two costs per unit. So you don't calculate 350 plus 360 divided by 2. That would be 355. Okay, that would be a simple average. We use a weighted average, so we need the units, okay, to correctly calculate the weighted average cost per unit. The second average we calculate, once again, we recalculate the total cost of the goods, and we divide by the new number of units, which is now 14. So we get this new value for the average cost. And note the first item, the value of the goods available is based on the previous average cost. Okay, so it's based on the average cost you have just calculated. However, the entries are the same. Okay, so the only thing that changes is the amounts. Okay, but the entries once again are really unchanged. Among the three methods, there's no change in the journal entries, just in the amounts. Now, before getting to the periodic system, which, as I said, it will require a different approach. Let's then look at the effects on the financial statements. Remember, the assumption is when costs are rising, which is not always applicable. I mean, there are cases, there are industries, there are commodities for which prices can be declining instead. Okay, so you have the opposite effect. So when prices are rising, the cost of goods sold is higher under LIFO than it is under FIFO. Okay. That means that if your cost of goods sold is higher, your net, since the revenues are not affected by LIFO and FIFO and average cost, it means that the net income will be lower, right? Because you have higher expenses and lower income. You can see why this could be desirable. First of all, because in case of inflation, it is more realistic. okay, because it compares the sales revenue with values which are closer to the current values on the market. Okay, so it is more realistic in case of inflation. But also, by lowering the net income, you also lower your income tax. Okay, so you generate tax savings, that's why it's so popular. So you pay less income tax when prices are rising. Okay, so this is one of the benefits of LIFO. So net income is lower under LIFO than under FIFO because the cost of goods sold is higher. In the balance sheet, however, when costs are increasing, FIFO generates the highest inventory and LIFO generates the lowest inventory. Okay. What is the consequence? That sometimes using LIFO, the inventory can be really understated. And this understatement is a problem because you read that this number in the balance sheet, it can be based on outdated prices. So this creates the so-called LIFO reserve. The LIFO reserve is the difference between the current value of the inventory on the market and the value you report in the balance sheet. This difference can be very large if you use LIFO because inventory can be based on old, outdated prices. Okay. Companies must disclose this in the notes. Okay. They must disclose the amount of this LIFO reserve. In periods when the prices are increasing very steeply, this can be very large difference. And sometimes a large percentage, for instance, could be 30%, 50%, 80% of the inventory. Okay, so it's a large difference. Now we're going to see an example of a LIFO reserve in a moment. And here we summarize the effects of the three methods on the income statement. The weighted average cost, as I said, is not mentioned because it produces a sort of middle ground solution, okay, between FIFO and LIFO. Look at the gross profit, that is sales revenue minus the cost of goods sold, okay, in the three cases. Let's forget about this part, the specific identification, what really depends on the exact units you're selling, but let's focus on FIFO and LIFO. Okay. If you focus here on FIFO and LIFO, you realize that under FIFO, the gross profit is 1,820, and under LIFO is 1,760. Okay, so it's lower because the cost of goods sold is greater. Okay, so less profits, less income tax. Okay, so this is the one of the consequences. However, in the balance sheet, once again, let's focus our attention on LIFO and FIFO here, and let's have a look at the value of the inventory at the end. Okay, clearly, under LIFO, the value is lower than FIFO. Remember, the assumption is that prices are increasing. Okay, because if you have prices that are decreasing, the effects are the opposite. Okay, so exactly the opposite. So when prices are decreasing, FIFO will generate the lowest net income and the lowest inventory. Okay, and LIFO will generate the highest net income and the highest inventory. So the assumption is prices are increasing, which is reasonable, but keep in mind there are always commodities or industries in which there are declines in prices. So in this case, you have the ending inventory is greater under FIFO than under LIFO. Okay, the LIFO reserve will be the difference between the current value on the market of your inventory and the amount you report in your balance sheet, which is based on old prices. So it's going to be outdated. Here you have just a summary of the different effects. Clearly, these effects will be different depending on whether the costs are rising or declining. Okay, so you just need to revert everything. when prices are declining, you get the opposite effects. So it doesn't really make sense to talk about the specific identification method because it really depends on what you are selling. But when you look at FIFO, LIFO, and the weighted average, it's always a middle ground solution. Let's see here. You need to revert all the effects when prices are declining. Okay, so you get the opposite effects when prices are declining. So let's have a look now at the financial statement of a company using LIFO. And I have here for you an oil company. Because oil companies very commonly use LIFO. It's very common in that industry. And one of the largest oil companies in the world is called ExxonMobil. So let me show you the financial statements. Okay, just a second, I need two hands for this. Okay, so this is a company reporting under the US standards, so they are actually allowed to use LIFO. Okay, and this is an oil company, the largest, okay, oil company, or one of the largest. I think it's the largest, and they use LIFO for their inventory of oil. Okay, so let's have a look at the notes to the financial statements, and in the past, all the oil companies reported very large amounts of LIFO reserves. Okay, right now it's a little bit less relevant, but let's say 10 years ago or 6 years ago, it was really a large amount. So let me find the. Okay, LIFO. Well, first of all, they explain that they use LIFO. Okay, they need to disclose this. Okay, they need to explain what is the method they use. Okay, all companies do that. They were using the energy codes. They're using FIFO or LIFO, a combination. They could use FIFO for some inventories and LIFO for others. Okay, so they can choose how to proceed. Here, you can read it. Hopefully, you can read this. They say that the crude oil, so it's the oil they extract, okay, are carried at the lower of current market value or cost. This is something we will explain. And let me try again. Okay. And this cost is determined under the LIFO method. Okay, so let's now have a look at the LIFO reserve. Here we go. Okay. Yes, there is this note here that says the aggregate replacement cost of inventories was estimated to exceed the LIFO carrying values by $5.4 billion in 2019 and 9.7 in 2020. Okay, so it means that they are telling us that even the current prices of oil on the market, the inventory we report is underestimated by 9.7 billion. Now, is that material? Is it a large amount or not? Will depend on how big the company is. Okay, so we can have a look at the balance sheet and see whether whether 9 billion are going to make a difference. But this is the LIFO reserve. Okay, so the idea that by applying LIFO, the value they report in the balance sheet is going to be lower than the current market value in case of increases in prices. And oil currently, maybe in 2020 there were declines in the price because of the lockdowns and so on. There was overproduction of oil in 2020. Maybe you read about those tankers that they could not dock because they were nowhere they were out of places to store, to just storage the oil. Okay, all the tanks were full, so they just kept the oil at sea, on the tankers. So there was those people that spent like 4 months at sea, just waiting to dock at the port. But now is so probably in 2020 this reserve was not that relevant, but in 2021 we're going to see an increase because now the prices are increasing and they keep using LIFO. So they keep reporting the inventory at the oldest prices. What is the value of the inventory for this company? Just a second because I lost this page. Well, for instance, the oil is 5.3. Well, it's a lot. I mean, they have 5.3 billions of oil, and this is underestimated by 9.7 billions. Okay, it's huge. It means that the inventory of oil you should add another 9 billions to get to the current value. So it's severely underestimated. Also, I think they talk about the total inventory. So you should look at these 14 billions here. Okay, so sorry if I'm boring you. I mean, you don't get this. You don't get to look at this very often in this university. So if you're bored, you can leave. Okay? The difference between university and school is that I don't care. I don't care if you study or if you don't study, if you pay attention or if you don't pay attention. I care if you disrupt my class. So if you disrupt my class, I get distracted. Okay? And I don't like it because unlike you, I must focus always. Okay? I can't just wander off with my thoughts. You can do that. You're welcome to do that. I don't care. But you do not disrupt my class. All right. If you want to talk, you want to discuss, you're welcome to leave. You don't have to attend. Thank you. So I was saying 14 billions, okay, will be the total amount of inventory, and it is understated by 9 billion. So even if you do just the total inventory, it's going to be a pretty large amount of LIFO reserve. Now, since we were talking about the lower of the cost of market rule, let me go back to my presentation and let me explain how we apply this. Applying the lower of cost of market rule to the inventory means that we need to compare the value of the inventory with the market value, which is something that, for instance, the oil company we just examined, they do that, and they say, well, everything is fine because the market value is greater than the cost, so we don't have to do anything. Okay, so because we apply the lower of the two values, the lower between cost and market. So this is a rule that is required by the accounting standards, including, you see, mentioned for the first time, IFRS, the International Financial Reporting Standards. These are the standards we use, okay, in Europe for large corporations. There is a difference between, they explain, there is a difference between what we mean by market, okay, under US GAAP and under IFRS is not that meaningful for us, okay, so we don't have to worry about it. But the idea is that the inventory cannot be reported at a value which is greater than the market value. Okay, so that's not possible. So you must choose the lower of the two values. And if the value of the inventory in your balance sheet is greater than the market value, it means that you're not going to recover this cost by selling the inventory because you're going to sell the inventory at a loss. Okay. Now, we could just sit and wait and see whether this happens or not, but that will not be consistent with the conservative principle. Okay. We need to be conservative. So we need to report bad news before they happen, right? So bad news is we are going to sell this at a loss in the future. Okay. Clearly, if the inventory is in your balance sheet, by definition, it hasn't been sold yet. Okay, so you don't know whether you're going to sell it at a loss or not. but you know that currently the value is lower, so you need to decrease the value of the inventory. Okay, so it's an impairment of the inventory. Impairment is the decline in the reduction or decline in the value of an asset. Okay, so we talk about an impairment. You can calculate impairments of property, plant, equipment, inventory, financial assets, whatever. Okay, in this case, we are talking about the inventory. So what are the reasons for this impairment? Okay, for market value which is less than cost. Okay. Well, for instance, in some cases, there are commodities which are traded, okay? So for instance, oil, and so we for the pandemic in 2020 might have generated this because the prices dropped and therefore the cost remains the same. So maybe you could have a situation where the lower value was the market value. In other cases, you might have products which are out of fashion. Think about the clothing industry, or obsolete. Okay, so out of date productions or inventories, if you want to sell them, you're going to sell them at a loss. So you're going to decrease the value of the inventory. This is one of the let's say areas that requires major attention from the auditors. And this is typically the area where some of the overstatements hide in the financial statement, because nobody really wants to tell the public, everyone, that we are holding inventory which are worthless. Okay, so they prefer not to do this if possible. So one of the jobs of the auditor is to make sure that they actually that the companies actually decrease the value of the inventory when it is necessary. One of the first jobs they assigned to newly hired auditors like our graduates is to go count the inventory, okay, and also see whether it is old stuff, something that's sitting there for years, because you can tell if some inventory has been there for years. Clearly, that's a sign that maybe the cost of the inventory is not realistic anymore, and maybe it should be decreased. How do we journalize this? Once again, your book has this idea that anything must be reported as cost of goods sold. Okay. Well, I don't really like this. The same as the shrinkage. Remember the shrinkage? We said, why should we change the cost of goods sold? Because this is going to change the gross margin. Why change the gross margin if we haven't sold? So a better solution would be reporting a specific expense. Okay, so an impairment loss. So an expense, clearly, okay, it's always an expense. We don't change the nature. But the point is, if you use cost of goods sold, the assumption is that you're changing the gross margin of sales, which is not really, I think, a good idea, because it's not like your sales are less profitable. You're decreasing the value of the inventory today so that you don't report a lower gross margin tomorrow. This is the purpose. And you have to decrease the value of the inventory. Okay, so you credit the merchandise inventory. This is called a write-down. Okay, an impairment or write-down is when you decrease the value of the inventory. We also learned that there are, besides write-downs, you have write-offs. A write-off is when you remove an item from your balance sheet completely. Okay, we'll talk about this when talking about accounts receivable. Sometimes the customer won't pay, so you simply write the account receivable off. Okay, so you remove it from your financial statements. In this case, we're not removing anything. We're simply lowering the value, so it's going to be considered a write-down. So this write-down should be better reported as an impairment loss. Yes?
This the account says the company has sold those tablets.
Those are not sold. This is the inventory. So at the end of the year, December 31st, this is the amount you haven't sold yet. It's still in the inventory. Okay. The problem is, what is the price at which I'm going to sell it next year? So I look at the market price, and the market price is 2,200, and the inventory is worth 3,000. So clearly, if I'm going to sell them, I'm going to generate a loss. I'm not sure yet, because maybe the price could increase again, but I don't know that. Okay, so in order to be conservative, I lower the value of the inventory without selling anything. I'm not selling. The inventory physically is still there. The number of units does not change. Okay, the cost per unit does. Okay, so I'm just lowering the cost per unit. That's why I don't like using the cost of goods sold, because it gives you the impression that you are selling something. You're not selling anything. Okay, the inventory physically is still there. The problem is the value of this inventory. Okay, so the problem is the cost of the inventory. Okay, so that's the idea. This is why it's better to specify that this is not the sale, right? So it's a decline, a write down, a decline in the value, a write down, an impairment loss. Okay, so that we understand what's going on. It is not a sale; it's just a decline in the value of the inventory. So eventually, in your balance sheet, the inventory will be carried at 2,200, okay, which is the lower of cost of market value. What if, after a while, the prices increase again? Well, you can recover the value. Okay, now you might say, why don't we just wait? Because maybe if we just waited, maybe the value in the meantime would recover. The point is, inventories are current assets, short-term assets. Okay, so the assumption is there's no time for this value to recover. So as soon as we know that the market value is less than the cost, we proceed with a write-down, with decreasing the value of the inventory. Okay, so this is the assumption. Then, if by any chance the inventory would be it can regain value, we can change this, but the maximum amount we can report will be 3,000. I mean, if the price increases and the value in the market becomes 3,500, we keep reporting 3,000. We don't report 3,500. Okay, so the historical cost will be the maximum amount of the inventory we can report. We cannot report inventory at a value greater than their cost. And in fact, going back to the example, what if the value on the market was 4,000? Well, you choose the lower value, which is 3,000, and you don't have to do anything. You don't have to journalize anything. Okay, so as long as the market value is equal or greater than cost, you don't do anything. Okay, because we don't update the inventory up to the market value. It is not current value accounting, it's historical cost accounting. Okay, so we keep the historical cost. We decrease the historical cost when necessary, but we do not increase the historical cost above the market value. Of course, you also need disclosure. You need to explain this. Okay, you need to tell the investors we did this, and the value was decreased because of the application of this rule. So tomorrow we continue with the periodic system. So far we applied FIFO and LIFO to the perpetual system. Tomorrow we will continue with the periodic system. Okay, so I'll see you tomorrow at 5.